Welcome back to Trading School. So last time we covered charts and volume. So if you haven't watched that video, I would suggest you to go and watch it. I have added the description in the I button as well. So today we are going to cover an interesting topic, trends in stock market. So you often have seen people talking and looking very excited and happy when the stock market is going up. And on the other hand, they may look worried when the market fall starts. So when the market is going up, that is known as bull market, and when the market is falling down, that is known as bear market. So let's understand some more concept on market trends. So the first thing, what is a trend? A trend is just the overall direction of the movement of a stock's price. Upward movement of stock price is called uptrend. Downward movement of stock price is called downtrend. And one biggest advice if you are trading in stock market is not to trade against the trend of the overall market. Now before we discuss about trends, let's see what support and resistance are. So support is an area or zone where demand is strong enough to stop the stock from falling. Here buyers are more willing to buy and sellers are less willing to sell. On the other hand, resistance is an area or zone where supply is strong enough to stop the stock from moving higher. Here sellers are more willing to sell and buyers are less willing to buy. Here you can see how the prices are taking support on the bottom line. So that bottom line is referred to as support zone. So when prices are reaching or reach the support zone, you may see a huge demand for the stock which will move the prices higher. If you see here, when the stock price reached the support zone, it bounced from there and again went up. On the other hand, if you can see how prices are falling down after reaching the resistance zone. So the resistance zone acts as a barrier from where prices are unable to move ahead. So whenever the stock price reaches a resistance zone, a huge supply, or we can say selling, can be seen, which drives the prices down. The support and resistance are very helpful when you are trading on dips or bounces. Now the thing is, how we can determine that a particular area is an important support or resistance zone. So there are several ways to determine that. We can check how long the prices have traded in a particular area. Like whenever any fall comes in a particular stock price, it falls till a certain area and always takes support from that area and starts moving upward, then we can say that that support area is very critical or important. Volume also plays an important role in support and resistance. If support level is formed on heavy volume, that means large number of trades have been taken place, and this was mark that support area very important. And the same implies with resistance as well. Now as we understood what is support and resistance, let's move on to the types of trends. The first thing, we have the uptrend. So uptrend is a series of successive higher highs and higher lows. That means during uptrend the price moves higher and penetrates the previous peak or high, forming a higher high and making a new low that will be always higher than the previous low, forming a higher low. The uptrend can be as short as a couple of weeks to a couple of years. A continuous uptrend is commonly referred to as a bull market, so it's a good advice to buy stocks on dips during the uptrend. Here you can see the continuous uptrend making higher highs and higher lows. This trend will continue until any new high fails to reach above the previous high or any new low penetrates or reach the previous low. Then we can say that the uptrend is going to end or has ended. This type of trend is formed when buyers are very aggressive to buy and less willing to sell. Next, we have the downtrend, which is opposite of uptrend. A downtrend is a series of lower highs and lower lows. That means during downtrend the price moves lower and penetrates the previous low, forming a lower low and making a new high that will always be lower than the previous high, forming a lower high. So a downtrend can also be short as a couple of weeks to a couple of years. A continuous downtrend is commonly referred to as a bear market. So it's a good advice to short sell stocks on bounces during the downtrend. Here you can see the continuous downtrend making lower highs and lower lows. This trend will continue until any new high penetrates the previous high or any new low fails to penetrate the previous low. Then we can say that the downtrend is going to end. This type of trend is formed when sellers are very aggressive to sell and less willing to buy. The third type of trend we have is sideways or range, we can say. A sideways or range market is the horizontal movement of stock prices. This is merely a consolidation of the prices after a successive uptrend or downtrend. It can also be short as a couple of weeks to a couple of years. So there may be a scenario where after a successive uptrend or downtrend, you may find the sideways trend, and for some weeks of consolidation, the trend may either reverse, that is, prior uptrend will now become downtrend, or continue the same uptrend. So one important thing here in sideways trend is that demand and supply is nearly equal. Here you can see that the stock price is in sideways trend. If you are new to trading, then it's better not to trade in a sideways market. It's better to wait for the break either upside or downside. But many traders use the trade in the sideways market as well. If you are trading in a sideways market, then oscillators are best to use. If you are not familiar with oscillators, then don't worry, we will be covering in the upcoming videos. Now, as we have understood the types of trends in the market, now let's see the various phases of market. As you can see here, the first phase we have the accumulation phase. This phase represents informed buying by some big players of the market. So these players can be any foreign institutional investors or foreign portfolio investors or any mutual fund company who recognize the market. For example, if any previous bear trend has ended, these investors start buying on heavy volumes to push the prices up. You can see because of their buying how the prices started moving up. Just after this, the second phase, public participation phase, starts, where most of the trend followers or traders who buy on breakouts start participating in the market. Due to this, the prices starts to advance rapidly and business news improves. So once the price rises rapidly, the third phase, distribution phase, starts, where financial newspapers, magazine news start printing or telecasting bullish stories about the market or the stock prices. And seeing this, the retail investors who rely on these stories and tips start participating in the market as well, making the prices to move more high. And in this distribution phase only, the same investor who begin to accumulate near the end of the bear market starts selling before anyone else starts. From this, you must have understood how the market cycle works. Now, as we have understood what is support and resistance in earlier sections, so let me tell you that sometimes it happens in the market that a particular support zone can become a resistance zone, or a particular resistance zone can become a support zone later. Let's see this with the help of a chart. Here you can see that whenever the price was touching the resistance zone, it was falling. The price touched the resistance zone 3 times and it falls. But if you see on the 4th time, the price broke the resistance zone, and from there the resistance zone now become the support zone. But there is no surety that this support zone will last. Any bad news is capable of breaking this support and it again can become a resistance. Now let's see how a support becomes a resistance. So here you can see that the prices were taking support on that support area. But on the 3rd time, it failed to take support and started falling down. And now after falling down for several days, when prices rebounded and started moving up, the same support zone has now become the resistance zone. So these kind of scenarios are very common in stock market. Volume and time plays an effective role to understand if the support or resistance is strong or weak. So as we already covered the uptrend and downtrend, support and resistance, let's move on to another topic, trend lines. A trend line is the most valuable, important and simple technical tool employed by every trader. So here you can see an uptrend line, which is a straight line drawn upward to the right along successive higher lows. So once the uptrend line is formed, subsequent dips near the line can be used as buying areas. On the other hand, a downtrend line is drawn downward to the right along the successive rally peaks or lower highs. Just like the uptrend line, once the downtrend line is formed, the subsequent bounces near the line can be used as short selling areas. For drawing a trend line, only 2 points are needed. The third point to make it a valid trend line. Breaking of the trend line is one of the best early signals or warning of change in trend. So now we understood the trend lines. Let's move on to the next topic, change in trend. As I told you earlier, the breaking of the trend line is one of the best early signals or warning of change in trend. So here you can see how the prices are breaking the uptrend line, and same as well as in the downtrend line. So once the uptrend line or the downtrend line is broken, you will see a new trend formation. The new trend can either be downward, sideways or upward. Sometimes you may see stock prices moving within two parallel lines, or we can say in a channel. So let's see what a channel is. So sometimes prices trend between two parallel lines, one the basic trend line and the another the channel line. So here in the chart you can see how prices are fluctuating within the channel. This is a downtrend having a channel line at the bottom. Many aggressive traders use this channel as a short-term opportunity to initiate short positions whenever the price touches the trend line, and buy the stocks when the price touches the channel line. Although buying when it's downtrend can be dangerous. So just like trend lines, any failure to reach the lower end of the channel in a downtrend or upper end of the channel during uptrend is often an early warning that the other line of the channel will be broken. So I hope till now we must have understood the basics of the stock market if you have watched the previous videos as well. In the next upcoming videos, we will be learning important chart patterns. So stay tuned. Thanks for watching this video. If you like this video, please like, share and subscribe the channel.